Mortgage rates are shifting, housing inventory is in flux, and the 2025 market outlook is anything but certain. In this episode, we're breaking down what the latest data really says about home prices, supply trends, and where real estate is headed next. I'm Kathy Fettke, and welcome to The Real Wealth Show.
You're listening to The Real Wealth Show with Kathy Fettke, the real estate investor's resource.
Today, we're joined by Mike Simonsen, the founder of Altos Research. Today, we're going to be discussing housing market data and what you need to know in this ever-changing market. Mike, welcome to The Real Wealth Show.
Kathy, it's great to be here.
It is such an honor to have you here because I have followed Altos Research for so many years, watch your videos, and here you are. So very exciting.
I'm glad we can reach some more people today.
Yeah. So for those who may have not heard of Altos Research, and I doubt there's very many people, but can you just explain what you do over there?
Yeah, we track the housing market. We track every week. We track every home for sale in the country, all the listings, all the new listings, all the pending sales, all the prices, all the supply and demand, and we bubble up the analytics for every zip code in the country. And we do that. We've been doing it for almost 20 years now. We track for the local level. And so like realtors or investors or people who have exposure at the local level can get Altos reports there. Or we also do like national level. So, big institutions and hedge funds and lenders use our data to understand the market all around the country.
Oh my goodness. What did people do before technology? Right? A lot of guessing, I think.
It didn't exist. The view we give at Altos didn't exist before we made it.
Yeah, no, it just makes real estate so much easier. So sort of. Let's just start with mortgage rates. What's going on there?
Well, mortgage rates have stayed higher for longer than pretty much anybody expected this year, and really for multiple years. But even if you think about this year, there were very few forecasters in the fourth quarter of 24 who were expecting rates to be at or above 7 through the year. So higher for longer. And what happens is, and as we're recording this in early May, rates have ticked up the last few days and they're pretty close to 7% again. And so as rates rise, inventory rises. So it's becomes more expensive to hold real estate, to buy and hold. So we buy and hold fewer homes and therefore the inventory builds. And that's been happening for 3 years, right? So inventory is building across the country. And so as a result, we have more inventory on the market than we have had at any time in the last 6 years. So
6 years. Oh,
yep. Now
wow.
going back to before 2020, June of or May of 2020, we have more homes on the market now than 2020 at the beginning of the pandemic. So the whole pandemic shortage is basically gone. At a national average, right? That's the impact of higher rates for longer.
That is so interesting because I keep seeing reports from people saying that we're not at 2019 levels of inventory yet.
Well, it depends on where you are. So
Yes.
Nationally, we're not yet to 2019. We're back above 2020, but we're not quite to 2019. I think by the end of the year, we will be above 2019 levels. So we will cross over that threshold sometime later this year. But it depends on where you are. So across the Sun Belt, inventory is up dramatically, and all the way across. The places that inventory is still restricted are really the Northeast, some of the Midwest. And the reason for that is that for a bunch of years, we've been moving from the north to the south. We've been selling in Connecticut to buy in Florida. And as it got more expensive to move, not just with mortgage rates, but with taxes and insurance and the cost of appliance, all the things have become more expensive. As it became more expensive to move in the last 3 years, we are moving less. So we're selling fewer homes in Connecticut. We're buying fewer homes in Florida. Inventory in Florida is high. Inventory in Connecticut is low. So like if I'm graduating college or I'm getting married in Connecticut, it's time to buy a house. I used to buy the house from the guy who moved to Florida, but that guy's not moving right now.
Oh, no.
And so now inventory in Connecticut is still actually, Connecticut is like the only state where inventory is still less than 2024. But I think that's going to switch over in a couple of weeks. So, that pattern, the Northeast has been restricted and therefore prices have been pushing higher in the Northeast. But Florida, Texas, Arizona, Georgia, and in fact, California has 50% more homes on the market now than a year ago.
Yeah, I bet that's because insurance is impossible.
So insurance, yeah, exactly. There's a lot of reasons for that. But California is still not at 2019 levels, where Texas and Florida have far more than 2019 available inventory.
So is it also because there was more building happening in the Southeast because that's where everybody was moving and less in the Midwest and Northeast?
Yes. So new construction obviously feeds into that, right? So, we've been building in the South and the Sun Belt to accommodate the movers. And so when people, and no, they're not moving, and significantly fewer numbers than in, 21, 22, 23.
Is it cause for concern? I guess it depends on who you're talking to.
On who you're talking about, right? And let's talk about, so concern. I would say that, there is, I think maybe the better question is there risk that home prices decline across the country this year? Yeah. And in fact, this week, the weekly pending home sales that we track were priced about 1% below last year at this time nationally. So the homes that went into contract the last week of April, first couple of days of May, were priced 1% below last year at this time. So that's the first time we've had a negative year-over-year reading since 23. So prices adjusted after 22. We had a few months of negative readings. So it is possible that home prices this year are basically flat or maybe down year over year. And so yes, and especially in those markets like across the Sun Belt, right? Inventory is up, and so there's a couple of things going on that is it cause for concern? On the one hand, home prices are down and going to be bearish headlines. On the other hand, there's nothing in the data that says home price crash. So I would call concern we have some markets where home prices are down 10%, and there probably will be more markets like that. But concern to me would be a home price crash broadly across the country. And there's nothing in the data yet that says that. So we have weak data, we have weak demand, we have more supply, therefore buyers are price sensitive. And so we could indeed see a flat or negative home prices, at the end of the year. Home prices fell in 2025 for the first time, since the great financial crisis. We could see that headline.
And it's mainly due to prices going up so much and affordability being just completely out of reach for so many people. But every time interest rates come down, more people are able to afford a property or, a little bit closer. Is there any chance that we'll see mortgage rates come down? I know that's a big question because they're bouncing all over the place and everything is unpredictable.
Yeah. So, at Housing Wire, we do a forecast and we looked at what we thought mortgage rates would happen this year. You could see scenarios where mortgage rates were over 7% and they got there very quickly in January. And, we could also see scenarios where, if we're lucky, rates get closer to 6%, or even below. And so what would be that scenario? It would be likely if, the jobs data comes in weak, so unemployment kicks up a little bit, and that means that the Fed can be easing, and then if other economic things like tariffs chill, then the spread between the 10-year bond and mortgage rates would also compress a little bit, which is still pretty high. That's a risk premium that mortgage investors pay, right? So So if the 10-year comes down and the spreads compress a little bit, that would be the scenario that would be positive for mortgage rates. If the economy looks like it's softening in the second and third quarter, there's a scenario where we could get lower rates that would buoy the housing market.
If those tariffs just, what did you say? Just calm down, just
chill. Yeah.
chill, just chill out.
Chill with those things. Because what happens is, right, that like all the uncertainty is doing things like it drives foreign investors away from buying the mortgage-backed securities. That means the rate has to go up. Right.
Mm-hmm.
It drives them away from buying the 10-year. That means the rate has to go up. And so, in April, we saw the big tariff announcements, and the first thing that happened was interest rates spiked. And so, there are a bunch of those factors, and there's, these are factors. We have no idea what comes next, right? We have no idea what tariff announcement comes next. We have no idea. So, but the scenario that would get us to lower mortgage rates this year would be we show some decreasing employment. So it's a little more unemployment, meaning the Fed is less worried about inflation and more worried about jobs. And we get a little mellow, we get a little chill in some of the financial markets. That would be the scenario that would get us to lower rates.
So what's a little confusing is as interest rates stay high, that there would be more inventory as opposed to rates are higher. People are just going to hold on to their homes and stick with these low, rates that they have. If they got them 5 years ago, or even it was like 3 years ago or something, they would stick with the home they have and not put it on the market. So why would people be putting their home on the market when interest rates are going up?
Well, the way to think about it is, and I get this question all the time, so it's very common. So, when rates are higher, the holding cost of real estate is higher, and therefore we hold less, we sell more, we buy fewer, and each of these conditions, like when rates are at 2%, I buy my second one and I keep the first one.
Mm-hmm. Maybe by a third.
Right? and when they're at 7%, I have to sell the first one to buy the second one.
Mm-hmm.
Or maybe I sell two to buy the third one. And so, it's like time to we're buying fewer. So all of those demand things, because the cost of holding is higher, we hold fewer. And that's really what it comes down to. So therefore inventory is climbing. And it's really, it's like to the day, mortgage rates started climbing in March of 22 and inventory started climbing in March of 22. Like it is really precise. And it's counterintuitive because, we think about like, well, I'm not going to sell my house. And we do have some of that lock-in rate. Like there is plenty of people with cheap mortgages who aren't going to sell. And that factor really is one of the reasons why we don't see any home price crash in the data.
Yeah.
Right. So it's totally true that like, it's not a good time for me to move. So I'm not moving and I'm holding on and I've got the best deal ever on this mortgage. And so, but each year some people have to sell or they choose to sell or they move. And so each year we have a few million fewer people who are locked in to that cheap mortgage. And those people now have, if I have a 7% mortgage that I bought in 23 and now or 22, and now it's time to go upgrade my house, I'm not keeping that one, right? So that one goes back on the market. So all of those reasons, as those holding costs are higher, and each year with higher rates, holding costs are higher for more people, and therefore inventory continues to build.
And is this across all types of housing, condos, entry level, high end luxury? I mean, or is it?
It is true. It is true across all types. The condo market right now is even softer than single family homes. So demand is, if you're buying, it's shifting to single family homes. If we just look at condos, there are more condos on the market now than in 2019. Like we're back over that number. Single family homes are not quite back over 2019 level. Condos are really interesting because like 20% of all condos in the country are in Florida, and the Florida market is like one of the roughest ones right now. So at Altos we like to talk about single family as a nice proxy for the whole country. But yeah, they're different, but they're all growing, and even in the Northeast, where it's been restricted, the new listings each week are starting to climb a little bit ahead of last year, and so that's a little bit of growth there in those markets that have still been very restricted.
And in Florida, is it mostly the coastal markets that are, that are flooded with inventory, or is it just across the board?
I mean, it's across the board.
Interesting.
It is the Southwest Florida, West and Southwest Florida has been the toughest. And it's also, those markets have had the hurricane damage the last couple of years. So there's insurance things going on there. There's a lot of things, but so like, Tampa, Naples, Fort Myers, Sarasota, all the West Florida markets are definitely the most impacted. I think actually Orlando's probably has the least inventory growth. But Miami is big, Jacksonville, like all of the big Florida markets are really, in that transition.
And is that true for Texas too?
Texas is Austin had the biggest price run up with the biggest inbound migration. So the Austin markets have the biggest shock of that migration slowing or stopping. And so Austin has had the fastest inventory rise as well as price correction. But, there are a lot of homes on the market in Dallas. And so it's true in Dallas too, a little bit less true in Houston, but it's all across the country. They're all across
in the suburbs as well.
Yeah.
Yeah. Fascinating. Okay. So if you were buying, would this be a buyer's opportunity? I mean, are you seeing price cuts such that it all makes sense now?
I think, that the way I've always approached it when people ask me that question is, if you can afford the house and you like the house, buy the house. If you can't afford it or you don't like it, don't buy it because you think you have to, or you think you got to get in, right? And so there are opportunities. There are certainly buyer opportunities that have not existed in many years. I live in San Francisco, and there are some super cool loft condos that are at 2014 prices.
My goodness.
Yeah, like
wow.
Real.
I went to San Francisco State. I love this city.
Maybe there's a bargain here. Like super cool stuff. Yeah. So, but that's not everywhere in the city. Like it's a handful of that neighborhoods that were like right close to the offices where people don't go to the office anymore. And so that like is a real specific thing. And so.
Now, are those condos in San Francisco, you go downstairs and there's a heroin party? I mean, or
we pay extra for the heroin party.
Okay. I thought so.
Yeah.
So specifically, San Francisco would be a buyer's opportunity. I'm assuming Austin too. But what about from a investor perspective, cash flow, rents? It's a different story because, you don't have to love the house. You have to love the numbers. Where are you seeing maybe the numbers work or rents going up or just limited inventory where an investor might still find a deal?
One of the interesting things about that I've learned in the data over the years is that you'd think about rents and home prices to be opposite each other. Like if people aren't buying, they got to rent. So that would maybe support rents. But it turns out that's not true. They move in tandem. So if home prices are falling, rents are falling. And if home prices are climbing, rents are climbing.
That I have not heard anyone say that. This is a first.
And that's because like if I'm moving to Austin, I might buy or I might rent. But if I stop moving, that demand is for homes, for a roof. And it shows up as demanded both rent and home prices.
So to you, it's really more of a demographic shift that's slowing things down,
That's right.
not necessarily local people saying, "Yay, finally my time, I can buy versus rent."
That's right. So then you think about like, if there's economic weakness that comes in this year, there could indeed be rent declines. And in fact, in our rental data, we track every home for rent in the country, and we're showing that rents nationally on single family homes are down about 1% from last year at this time, nationally. So then you're doing like, okay, you want to understand the current cash flow and the long-term assumptions. I gotta assume that Americans are going to want to still move to the Sun Belt, and that will resume. That migration pattern will resume. Like if have spent 40 years in Buffalo and now like your kids are gone, you still want to move to Florida, right? It's like it's more expensive right now, but so you have to assume that those demographic patterns will resume, and that they're just on hold for now, given the current economy.
Okay, so think long term. Flipping is not long term, it's short term. And I think you would agree that flippers need to really, really understand the exit number and not count on appreciation saving their deal.
Yes, I think so. And there's a lot of, things that can happen really quickly. And, in the Altos data, we track things like the percentage of homes with price reductions. And you can see if you're thinking about flipping in a neighborhood and we're watching the price reductions climb every week, and you're going to have that house for 90 days, is that like you need to be ahead of that curve, and watching more and more homes do price reductions each week. And, over the years, I've watched, lots of investor friends get caught, at the wrong point in that cycle. When, they 90 days later, it's like, wow, things slowed way down, but you can see it in the data right now. And so those are definitely things to pay attention to. And there are markets, there are other, for example, neighborhoods in San Francisco where, condos are like, they go in 7 days. And so the price reductions, like normally about 30% of homes take a price cut before they sell. And so, but in this, like I was just looking at a neighborhood today and it's like 6%. So basically things go in a week, they're like price, they're going at or over asking. And so if you are, that's an analysis you can do at a local level to understand, is this the right time to do a flip?
Yeah, I mean, my niece is an agent in the San Francisco Bay Area, and she just had an open house and it was packed. She had like 70 people on the first day. So it just depends. But I did read an article recently, I think it was a Bigger Pockets article, that the LA area has about the same amount of people as the San Francisco Bay Area. And yet the San Francisco Bay Area has like twice the GDP or something. There's just so much money up there. And now AI probably gonna land there.
And we were talking about the inventory is like, it's like the Bay Area, San Francisco Bay Area has a chronic shortage of inventory, very few homes per the population. And so, they like if you take the same demographic between Silicon Valley and Dallas suburbs, Dallas has 10 times as many homes for sale. And so the price sensitivity is much greater in Dallas.
Well, Mike, I could be a trust fund kid today if my dad had just listened to my mom, because I grew up in Menlo Park. The homes were $70,000. The little ones were 50. And she said, we should buy some of these. And my dad was like, oh, that's crazy talk. Anyway, yeah. I would have been a great trust fund kid. I would have been great. All right, Mike. Well, I really appreciate you joining me here on The Real Wealth Show. I hope we get to have you back to make more sense of this wild and crazy market.
Kathy, great to talk to you.
And thank you for joining me here on The Real Wealth Show. If you want more data on the housing market and which markets we recommend investing in today, just visit realwealth.com/1500. That's realwealth.com/1500 to download your free PDF on the top 5 cities to invest in today. I'm Kathy Fettke. Thanks for joining me here on The Real Wealth Show, and we'll see you next time.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.